Something unusual is happening in the stock market. European and Asian markets are performing better than the US market. If you look at their performance since the beginning of the year, US stock prices have fallen sharply, while markets in Germany, Hong Kong, and broader Europe have gone up. So, what's going on? Investors are increasingly convinced that Donald Trump's trade policies, especially the erratic back and forth of announcing tariffs one moment and scrapping them the next, will hurt American companies more than those overseas. At the same time, other major shifts are taking place in the markets. One is that investors are no longer betting on strong economic growth. Instead, they're growing more worried about the possibility of a slowdown. You can see this in the way they're pricing value stocks versus growth stocks. Value stocks have been outperforming growth stocks by a wide margin. Value stocks are those that trade at relatively low prices compared to their fundamental earnings. This means that in an economic downturn, they often hold up better, because their prices are already low and there's less room to fall. Growth stocks, on the other hand, promise higher future returns but are priced expensively relative to their earnings. That makes them more vulnerable when the economy weakens. So, when you see value stocks outperforming growth stocks, it signals that investor sentiment is shifting from optimism to pessimism. And typically, when that shift happens, certain assets tend to do well. Gold is one example. Investors often buy gold when they're nervous. In fact, gold prices have been performing extremely well lately, repeatedly hitting new highs. But other assets that investors usually turn to in times of stress haven't been doing as well. One is US Treasuries, whose prices have actually fallen in recent weeks. Another is the US dollar, which usually strengthens when investors are nervous. Instead, the dollar has weakened, so the usual correlations we expect to hold in times of uncertainty have been breaking down. Now, a third shift may seem less obvious but is equally important: the rising cost of borrowing yen. For most of the past decade, borrowing costs for yen were near zero or even negative. But in the past few years, they've climbed sharply. When borrowing costs are close to zero, it's very useful for traders. They can borrow yen cheaply and use it to fund positions with higher returns. For example, borrowing yen at low cost to buy stocks can generate attractive profits. But as yen borrowing costs rise, that strategy becomes less appealing. In fact, last summer, when the yen surged, many traders quickly unwound their positions, causing major volatility in the stock market. Although markets later stabilized, borrowing costs have continued to climb. If this trend continues, could lead to more unwinding and greater market turbulence. Of course, the price moves of the past few weeks are just that, the past few weeks. You wouldn't want to make any big decisions based on such a short window. But if these underlying structural shifts in the market persist, then it's definitely something worth paying close attention to.